All right, let's do this. Mr. Mash here. Welcome to the fifth part of private markets. And in this fifth part, we are going to look at private special situations. I want to split this fifth part into 6 subsections. These 6 subsections are going to be, the first one is the characteristics and risks of special investment situations. This is going to be subsection number 1. Subsection number 2 is going to be the features of distressed debt and financial alternatives, financing alternatives for issuers in financial distress. So this is going to be the second subpart. In the third subsection, we'll look at bankruptcy and other special situations, but we are only going to do the first one here. So this is going to be the third subsection. We look at bankruptcy, and then we look at investment strategies in distressed situations, particularly the Merton model and the put-call parity. The fourth subsection is going to be on capital structure arbitrage, asset swaps, and convertible bonds. So this is the fourth one. And then lastly, we will do these 2 as the fifth one. The due diligence and then risk and return in the context of strategic asset allocation, as we do with all other private investments. So this is going to be the fifth part. And as always, we conclude with part 6 being practice. Very important part of your learning. Let's get right into this. Your special investment situations are going to be short-term opportunities driven by events or market conditions impacting the issuer's value. So you must take note of the fact that the special investment situations are a bit different from all the other private investments we've talked about. We have talked about all the other private situations that we spoke about, all the other private investments. We said the private investments are long-term in nature, ranging from anything between 10 to 10 years. But on the contrary, your special investment situations are going to be short-term. So this is a major difference between other private market investments and special investment situations. These ones are short-term opportunities, and these are going to be driven by different types of events. The events can either be, so you see that the events can either be financial in nature or non-financial. The financial events are financial distress 1 and financial dislocation 2. The financial distress is idiosyncratic in nature. So this financial distress is going to be idiosyncratic in nature. What this means is it's specific to a particular entity. It's specific to a particular entity or sector. And is going to include things like bankruptcy and liquidation. Whilst your financial dislocation, this is more broad and it's market-wide. So this is going to be market-wide. And so if it's not idiosyncratic, it's systematic. It's systematic and it's market-wide, caused by things like a financial crisis or political instability. The implications of financial dislocation are going to include things like price inefficiencies and liquidity issues. Okay. These are going to correct themselves in the long run when the market corrects and the crisis is over and so forth. So financial dislocation is temporary. This is temporary. But the financial distress has to be dealt with things like restructuring, refinancing, and so forth. Non-financial events could be fraud, litigation, or a failed business combination. So that's the special investment situations. Types of issuers include corporate and sovereign issuers, governments. Investment vehicles can be private, special situation funds, high-risk debt strategies, opportunistic investments. And the market presence for special investments, these are quite small. So these are probably the smallest in private investments. They are a small fraction of private markets, but they are expected to grow. According to Preqin, the alternative investments data company, the special investment situations are expected to reach over 1 trillion in assets under management by the year 2027. It's quite soon. The key characteristics are that they are driven by credit events that affect debt or equity values, so the value of the company, and they have a special focus on companies in distress. You're going to realize that most of the time, special investment situations focus on companies that are in distress and or going under restructuring. The strategies that are used for investment include short-term trading strategies, so they can do a short selling strategy when there are credit events or business combinations like mergers and acquisitions, control of firms post-bankruptcy to increase the value and then resell it, or other complex capital structure transactions. We are going to talk about this when we discuss the metal models and the other capital arbitrage models. The role of the managers, the general partners. Remember, we said the general partners have to have more knowledge beyond the public fund managers, in the sense that they need to know a lot of things. They go beyond understanding financial statements. They need to understand the legal environment. They need to understand what happens in case of bankruptcy. They need to understand the valuations of these special investment situations. And they should also be able to do scenario analysis. What happens if there is a recession? What happens if the economy is growing? Do different scenario analysis and look at the returns. And in terms of asset allocation, your special investment situations, they have a low correlation with traditional assets, hence they provide diversification benefits. We'll talk about this at the end when we discuss risk and return characteristics, but they have diversification benefits because of the low correlation, and the returns are driven by short-term price changes and idiosyncratic factors, which I said idiosyncratic are usually associated with financial distress. Okay. Assume the value of a firm, VT, at time T is given by this VT, and at that time, the firm's zero coupon debt is given by D. What you realize is that as long as the value of the firm is bigger than the value of debt, the firm is solvent. But once the value of the firm goes below the value of debt, then the firm becomes insolvent. And the debt holders have a priority over the firm, over the equity holders. If the value of the firm is less than the debt, what will happen is that the debt holders are going to receive less than what they are promised, and the equity holders, they get nothing. So the relationship that bondholders and shareholders have is an option-like relationship. The shareholders, because they are betting on the value of the firm going up, they are going to be, if you buy equity in a firm, what that means is on that share, you are going to be bullish. You are betting on the value of the firm going up. So you are taking a long position. When you're bullish, you're optimistic on that asset. And effectively, you own a put on the option. So if you're owning a put, if you're an equity holder, it means you have a put that you've written on that stock, such that when the value goes down, you don't get anything when you write a put option. The person who benefits now is the debt holder, who gets everything and you get nothing. So the put premium can be interpreted as the credit spread that is paid to debt holders. So a distressed investor might capitalize in two outcomes. Either they purchase the bonds of an issuer trading at a discount, expecting that the value is going to go up at some time, or they short sell stock. So they are short selling stock, so such that at a time when the firm is now doing better, then they take a long position and sell that stock and make a profit from that as well. Okay. Alternatively, the investors are going to take an active role in restructuring the company, such that the value of the firm goes up and then later on resell it again, make a profit from so doing. The risk associated with special investments include credit risk, which is the risk of the issuer not meeting their obligations. They are not able to pay. In that case, the debt holders become residual claimants, which means they claim whatever is left, the residual of the firm, and the equity holders get nothing. The market timing is very important. So there's a market timing risk. If you miss the timing or if you misjudge, you might end up making significant losses and not getting anything out of that. So there's credit risk, market timing risk, asset valuation uncertainty. It's very difficult to value special situation investments. Because of these complexities, because of the liabilities, varying asset values, and potential different outcomes, based on whether the company will grow or not, you have uncertainty in the valuation of the asset. And then also the legal and restructuring risks. Distressed situations often involve bankruptcy, which is very costly and time consuming. So investors need to assess the outcomes of the bankruptcy process carefully. And then macroeconomic interest-specific risks. Remember, the macroeconomy goes through a business cycle where there is recessions and booms and contractions and so forth. So if the economy goes to this trough in the downturn, this increases the risk of default, especially for high yield bonds, your junk bonds. And for these junk bonds, and industry-specific downturns and company-specific risks like management failures or product recalls can exacerbate financial distress. It can worsen it. Okay. There are also other additional risks that are unique, like the investor liquidity. If the investor has limited liquidity and there's an increase in volatility, this will force the sale by market participants and will result in delistings, because these companies might not, because of a lack of liquidity. For you to be listed on a particular stock exchange, you must be able to meet certain requirements. Now, if you don't have those assets or the liquidity required, you have to be delisted from the stock exchange. So delisting might be a consequence of investor liquidity risk. And then operational risk. This is the risk of your operations not going smoothly. You're losing customers, you're losing your employees, you're losing your suppliers. And then because of this, there's a risk of non-payment or liquidation during restructuring. Your legal risk, these are challenges that you have to do with of a legal nature, litigation. And this, when creditors have to be paid, when they win a legal battle, they have to be paid, and it reduces the assets for claims. Okay, so you have to weigh the risk and benefit of the legal risks. With sovereign risks, developed markets. So sovereign risk, this has to do with governments, right? This has to do with governments. In developed markets, they are lower risk because these governments are generally doing better and they have reserve currencies. But developing markets, mostly in Africa and some Asian countries, these are very high risk and there's less economic diversification. And then there's also a risk of reputation, where companies have not been doing well, have not been complying with ESG, environmental, social, and governance considerations. This might result in potential displacement of workers and community disruption. There's a risk of this happening. And an example is heavily indebted poor countries. These are extremely high risk and they have a poor reputation of paying back the money. Event-driven situations in major arbitrage. So event-driven situations are common drivers of valuation changes, including your mergers, your acquisitions, your divestitures. Remember, your divestitures, these are spin-offs where you sell part of your company or assets or subsidiary so that you can streamline operations, raise money, and focus on your core activities. Okay, so these are different events that might trigger certain investments. These are drivers of valuation changes. Okay. Your major arbitrage is a special situation related to business combinations that involves capitalizing on price discrepancies of securities. So these securities may belong to the target, the acquirer, or related parties. If you have two companies, a target company and an acquirer company, these companies might have different values. Chances are, if you're an acquirer, you're a big company, you have shares that have a higher value. And if you're a target company, chances are, if someone is targeting you, it means they consider your value to be less, such that when you come together, the value of this company is going to move in an upward direction, and the value of this company is going to move in a downward direction. They meet in the middle where they have the target company is a relatively higher value, right? So that's the concept of major arbitrage, which we're going to discuss in detail just now. And This leverage debt in major arbitrage, this is the use of borrowed funds, and these borrowed funds are used to generate leveraged returns. It depends on expected payout and confidence in successful transaction closure. Trigger events, these are usually triggered by an announcement of a potential transaction. So once a potential transaction is announced that this company is targeting this company, then the event is triggered, and market participants now want to buy or sell shares based on that particular announcement. Let's look at two different transactions here where there's a major purchase method and corresponding arbitrage position. The cash for stock, this is simply a situation where you are buying, the acquirer is going to pay cash to the target, and in exchange for the cash they get shares of the target company, right? So the strategy is to buy the target company shares. They buy using money, cash money. Okay, so the acquirer gives cash to the target company's shareholders. In exchange they get shares or ownership of the company. Remember, shares imply ownership. And this is the simplest, this is quite the simplest form of the major purchase. The other type is stock for stock, where the acquirer offers its stock to the target and the target then offers its stock to the acquirer. And you'll find that the stock of the acquirer is usually worth more than the stock of the target. So they're going to swap this. Maybe for every share of the stock of the acquirer, the target is going to give the acquirer, if it gives one share, the target is going to give two, because chances are it's a smaller company. So you have this ratio of 1/2, 0.5. So they buy target company and sell acquirer. Selling acquirer is like giving part of their stock. Okay, so when a major or acquisition is announced, whether it's going to be cash or it's an all cash deal or an all stock deal, the market price of this target company is going to be expected to rise. So the expectation, because this one is acquiring, we expect that it is a higher price in value, and the targeted company is expected to have a lower value than the acquirer, as I explained earlier. So the target company price is going to remain below the announced price, given that there's uncertainty associated with closing the transaction. Once a deal is announced, it's not a given, it's not written in stone that this deal is going to go through. It might not happen. So there's still uncertainty related to these particular deals. Okay, and then the arbitrage spread. The arbitrage spread is going to be calculated by looking at the difference between the announced acquisition price, so the announced price minus the post announcement market price. The price that the firm announced initially, the one that they want to pay, and then the post-announcement market price, the value of the shares in the market at the time at which now the transaction is going to take place. This gives you the arbitrage spread. Let's see how this works with a very simple example where we have Winslater and Prusnido. In this instance, Winslater has 100, the shares are 100 per share, and that's Winslater. And then Prusnido, prior to the acquisition announcement, has 40 per share. But Winslater wants to offer a 25% premium. They want to offer a 25% premium to Prusnido, right? And then, so the question is asking you to calculate, in this instance, is an all cash purchase. With an all cash purchase, Prusnido's shares and share price increases to 46. So you see the share price of Prusnido is increased to 46 upon announcement. To get the arbitrage spread, what you're going to do is to take the value of this the announced acquisition price, and then you subtract the post-announcement market price. So this is the announced acquisition price, this one. They offer a 25% premium. So it's going to be a 25% premium on the price of 40 minus the market price. The share price increases to 46. So the answer here is going to be 50 minus 46. It's going to be 4 Canadian dollars per share. So this now is going to be the arbitrage spread for this particular transaction, right? And part of the question is asking, discuss one fundamental reason why the arbitrage spread is greater than 0. The arbitrage spread is always going to be greater than 0 because there is uncertainty in these transactions. In a deal being announced is no guarantee that we are going to see this deal through. So because of this, the arbitrage spread is going to be greater than 0 because there is a significant probability that the acquisition will not be completed as of the acquisition announcement date. That's where the arbitrage spread is going to come from. Let's look at the second one. The second part is discuss the trade that the mid-arbitrage investor would likely construct if Winslater announces a stock. Now this is a stock for stock transaction, right? In the stock for stock transaction, if the Spruce Needles shares increases to 46 again, upon announcement the price increases. So post announcement the price is 46. So the Winslater's price is unchanged. The Winslater's current price is 100. Can you see this? The Winslater's price is 100, and this is the acquirer. And you can relate this now to the target firm, where the value, we said it's still the same here, and it's 40 multiplied by 1.25. So you have this for 150 here, which means 1 share is to 2. In value, the value is such that for every share of Spruce Needle, you get 2 shares of Winslater in terms of the values that you are given there. So basically what Winslater is going to do, because it's 1:2, Winslater is going to offer 0.5, half of its shares it's going to offer half share to Spruce Needle, and this half share is going to be offered at a price of 100. So this is going to be offered at a price of $100 per share. And then you would find that now, because it's half share, $800 per share, this is going to be 50 for a share. It's going to be 50 per share. Hence the arbitrage spread is then equals to this 50 minus the announced value of 46. If you subtract these two, again, you're going to get an arbitrage spread of 4 Canadian dollars per share. You must end up with the same answer, whether it's in all cash transaction or it's a stock for stock transaction. Okay. And then your major failures. Why are these majors failing? The acquirer with liquid shares may attract short selling after a major announcement. So this strategy of short selling, you announce and then investors get this impression that because if the assets are liquid, it means they can be sold, bought and sold, right? if you announce, the short selling strategy is basically let me explain this. Remember, we said the acquirer is the big company and the shares are high in value. And the target company is the one which has shares which are low in value. Because this company wants to buy this target, the expectation is that once the deal goes through, the value of this share is going to go down, whilst the value of this share is going to go up. Okay, because this company has been bought by a bigger company, so its value must go up. This company is buying a smaller company, its value must go down. So the short selling is selling these shares at a lower value. If the deal goes through and these two companies combine, because now they are one company, there are a lot of synergies that come through with companies coming together. And because of these synergies, ultimately the value is going to go up. And if the value is going to go up, after they short sold at a lower price, they are going to then increase the value of the shares later on by through the synergies. Okay, so they buy the shares, they short sell them, they increase in value, they make money. To minimize stock price declines, an acquirer often offer a combination of cash and stock because the shares could be diluted. So if they are diluted, the stock price goes down. Hence, to minimize that, they can offer both cash and stock. Regardless of whether a merger is announced using cash or stock or a combination, the main risk is that the transaction might not happen. This is the main risk, that the transaction might not happen, right? Reasons for major failure, they include things like debt financing becomes unavailable or less attractive. The government or regulator bodies, they block the merger, like your antitrust, where they say, you can't have this oligopoly here, or you can't have, because remember, oligopolies, they dominate the market and they do whatever they can, engage in anti-competitive behavior where they come together, they agree on prices, they agree on whatnot. Or monopolies, actually. One big company takes over another company and controls the market and does whatever they want. This can be blocked by the government regulation. Like in South Africa, there's what they call the Competition Commission, which blocks such behavior by companies which is anti-competitive and does not benefit consumers. So government can block that, or there can be changes in the economic or industrial conditions, which makes the merger more or less appealing. There is a recession which increases credit risk. It's a problem. Or due diligence might actually reveal that there was fraud in the books of these companies or material representation of information. There could also be a third party that is going to bid or make a counter offer. So this might not actually result in a failure of the merger, but will just delay the process, which results in the price potentially going up because now there are more companies. Remember, demand and supply. The higher the demand, the higher the price is likely to be. Let's wrap this up with exercises. I hope you managed to follow. And you remember that this is just an introduction. I don't want to overwhelm you. Before we get to the exercise, I want us to just quickly go what happens if the merger happens and it's completed. What is likely to happen? Okay, the acquirer is going to take the assets and liabilities of the company, right, of the target company. And the business combinations present debt-related merger arbitrage opportunities. If there was a change of control clause, often this change of control clause is going to require that the issuer has to offer to repurchase bonds at a fixed price that was pre-agreed, or if a new owner acquires a significant percent of voting shares. So if there's a new owner that acquires the entire company or a significant percentage of voting shares, the issuer has to offer to repurchase the bonds at a pre-agreed price. This is going to allow the lenders and the bondholders to sell back their bonds to the issuer at a gain or negotiate better terms for their debt. So change of control clause is meant to protect the lenders or the bondholders so that they get better terms for their debt. Maybe they don't trust the new acquirers, or they don't like them, or they don't think they're going to do it. Whatever the case might be, they renegotiate the debt terms. Without any change of control, the acquirer might initiate a bond tender offer. So this bond tender offer is to buy back the debt at a premium to the market value or to the market price. And this is going to involve either a cash offer or to say, you know what, we are going to give you part of the stock of the company. So they are going to exchange the bond for newly issued securities of equivalent value to the debt. So that's what would happen without a change of control clause. There will be a bond tender offer. There are other strategies known as capital structure arbitrage. We are going to talk about these in detail in the next section. Maybe not the next one, but the third sub part of this section. These are more complex and they combine long, short debt, equity, and credit default swap positions. And these are done so as to exploit potential mispricing in the market. There are also hybrid securities, which you are now very familiar with, called convertible bonds. And these, they provide an opportunity exploiting mispricing in interest rate risk, credit risk, volatility, and equity risk. What the bondholders can now do is that they exchange their debt for equity. If the value of the company goes up, they change it at a pre-agreed price using a conversion rate, which was pre-agreed when they entered into that convertible bond contract. Leverage is always used in a major arbitrage and convertible arbitrage strategies to enhance. The idea is that the returns should be enhanced. So let's look at this exercise. You can pause, come back, then we'll quickly do it. All right. The first question, you want to just discuss the difference between special situations investing compared to investing in other private market asset classes. I mean, there's one main difference that I emphasized when we started. The main difference is the time frame. This is the main difference. So which one is long term, which one is short term? Almost all private investments are going to be long term. Typically 5 to 10 years, they are long term. But the special situations are going to be short term. So your special situations, just always remember that your special situation investing is going to be short term. And whilst the private markets are going to be long term. Okay, these special situations, they want to create value. The idea with special situations is to create value, and the creation of value is going to be driven by an outcome of discrete events. These discrete events could be things like the restructuring, the bankruptcies, the divestitures, the litigation, the spin-offs. We spoke about these discrete events, right? The value is going to be created from these discrete events, and these typically occur over a short period of time. All right, so that's the main difference there. Let's go to the second question. Discuss the basic return risk trade-off being considered by investor in a cash for stock major arbitrage opportunity in which an acquirer bids 70 for a target company and the target stock price rises from 54 to 66. Assume the target stock falls to its original price if the major does not close. So we have scenario number one, and they say in scenario number one, it's successful, in which an acquirer bids 70. So the acquirer bids 70, and this is successful. If it's successful, the stock price rises from 54 to 64. So remember, we are going to look at the pre-announcement price, which is this one. And then the market value after the post-announcement, this one. And so the percentage change here is going to be the pre-announcement price minus the post-announcement price over the post-announcement price. Okay, if you multiply this by 100%, you're going to get a 6% return. This is in scenario one, where there is success. The major went through successfully. Then scenario number two, if the major does not close, if it doesn't happen, what's going to happen? The price is going to go back to 54, right? But now the price had to be 66 at acquisition, upon the acquisition announcement. So you are going to get this 54, which was the original price, minus the 66, the post-acquisition announcement, divided by 66, you multiply by 100%. So if the deal doesn't happen, the risk is that there's going to be a loss of 18.18%. And this is when the deal does not close. Okay, so make sure you can be able to calculate these two different types of scenarios and their returns. Then the last one, which one of the following best states the credit risk? So we want to know what the credit risk is faced by an investor in a distressed debt of an issuer post whose default is imminent. The word imminent means it's very, very close, very close. It's about to, probability of default is close to 1. Probability of default by the issuer. This is not correct because this is very close to 1. Probability of default is very close to 1 because the event is about to happen, which means C is not correct because it has this wrong answer. Hence, the final answer is going to be by elimination. Answer is B. So the answer is B, the loss given default, right? Remember, they won't ask you to calculate this. I don't think they would, but because you know anyway how you calculate this. The loss given default was just the expected exposure multiplied by 1 minus the recovery rate. And this one, this is the expected loss with an underlying debt as a percentage of the face value. The investor is taking a view on how the realized recovery rate compares to the expected recovery rate priced into the security at the time of the investment. So the loss given default is how much you will lose, assuming that the bond has defaulted. Answer is B. Sure, you'll be able to figure it out. But in the next session, so this session is done. I hope you guys enjoyed this. If not, because I think sometimes I talk fast, but just pause, rewind when you don't understand something. In the next section, what we're going to be talking about is distressed debt. So we're going to look at distressed debt, and also we're going to look at the financing alternatives for issuers in financial distress. You're stuck with me for a bit whilst we go through these private special situations. But until the next session, I want you guys to enjoy this. Mr. Mash is out. Practice, practice, practice. See ya.